Hi everyone, welcome back to my channel. I'm Dean Aronovich, and I'm here for another video keeping you in the loop with what's the latest in the commercial real estate market. The industrial real estate game has completely flipped in the Greater Toronto area, and if you run a business that needs warehouse or industrial space, what I'm about to share could save you hundreds of thousands of dollars. There is a window open right now that experts say will likely slam shut before the end of 2026. The question is whether you'll take advantage of it or kick yourself later for waiting too long. Let's rewind for a second. If you tried to lease industrial space in the GTA over the past several years, you know exactly how brutal it was. Landlords held all the cards. Rents were skyrocketing, competition was fierce, and tenants were basically taking whatever they could get with zero negotiating power. It felt like trying to rent an apartment in a city where everyone wanted to live and nothing was available. But heading into 2026, something significant has changed. The national industrial availability rate hit 5.5% in the first quarter of 2026. That might sound like just a number, but context makes it meaningful. The last time availability sat at this level was between 2014 and 2016, a period that most industrial tenants remember as relatively balanced and fair. In the GTA specifically, availability ended 2025 right at 5%. What that means in practical terms is that tenants now have breathing room they simply did not have before. Here's where it gets really interesting for your bottom line. Average asking rents across the GTA dropped between 4 and 7% year over year by the end of 2025, landing in the range of $15 to $17 per square foot net. And beyond the rent reductions, landlords are doing something they essentially stopped doing years ago. They are offering tenant improvement packages and real concessions. We are talking about actual incentives to get you through the door and signed on a lease. That has not been the reality since before 2020. Now here is the catch, and this is important. Not all industrial tenants benefit equally from this shift. If your business needs smaller spaces under 25,000 square feet, those smaller bay properties are still tight and remain competitive. The real leverage lives with businesses looking for larger blocks of space, particularly anything over 75,000 square feet. Those tenants right now have significant negotiating power. So why not just wait and see if conditions improve even more? This is where the data tells a very different story. New industrial supply is shrinking dramatically and fast. In 2023, developers delivered 17 million square feet of new industrial space across Canada. In 2024, that number dropped to 14.3 million square feet. By 2025, it fell again to just 11.1 million square feet. That is a consistent and steep downward trend, and the reasons behind it suggest it is not reversing anytime soon. Construction costs have gone through the roof, partly because US tariffs on steel and aluminum have climbed to 50%. That makes building new industrial facilities dramatically more expensive, and developers are now baking in cost contingencies of 10 to 20% or more just to account for that uncertainty. When building becomes this expensive and complicated, fewer projects get started, which means future supply shrinks, and when supply shrinks, landlords regain their leverage. Industry analysts at CBRE expect the current tenant-friendly conditions and concessions to start disappearing by mid-2026. But perhaps the single biggest reason why industrial tenants need to make a decision now is something that has nothing to do with construction costs or vacancy rate. It is a geopolitical event with enormous economic consequences. In July 2026, the Canada-United States-Mexico Agreement, known as CUSMA, comes up for renegotiation. This trade deal governs an enormous portion of the manufacturing and logistics activity that drives industrial real estate demand in the GTA and across the country. The uncertainty around this review has already been suppressing leasing activity, especially for large warehouse and big box spaces in areas heavily tied to manufacturing and logistics like Toronto East. Manufacturers and major logistics companies have essentially been sitting on their hands, delaying expansion decisions while they wait to see what happens with trade policy. Here is the critical insight. If CUSMA gets resolved favorably, that pent-up demand does not slowly trickle back into the market. It comes flooding back all at once. And when that flood of demand hits a market where supply is already shrinking, the window for tenants closes almost instantly. The negotiating leverage you have today evaporates. The bottom line is straightforward. A significant wave of GTA industrial lease expirations is coming over the next 3 years. If your business is part of that wave, waiting is the riskiest move you can make. The combination of stabilizing availability, softer rents, landlord concessions, shrinking supply pipelines, and the looming CUSMA review creates a narrow and specific window that may not exist 6 months from now. The clock is genuinely ticking. Get your real estate strategy moving before this opportunity is gone. If you find this video helpful, do not forget to like and subscribe for more deep dives into the commercial real estate market. If you're exploring opportunities in Toronto's evolving commercial market, let's connect. Contact me and let me help you find the perfect space for your venture. Thanks for watching, and don't forget to like and subscribe to keep yourself updated.